Well, good afternoon again. We are very excited to be here, very proud to be sponsors of BVC. A little about who we are, why we're here, and what you'll learn if you hang out with us for the next 30 minutes. We are the fastest growing insurance brokerage in the nation. We're experts, 3 of us are sitting here in front of you, but we're experts in providing insurance solutions that are going to help you with protecting your business and also the health of your employees. Something that is unique to us is we are a majority employee owned. So like many of you in this room, we have that entrepreneurial spirit, and we are very invested in the community, which is why it's so important for us to sponsor this particular event. Today, we are going to do 3 things. We're going to educate and help with the mystery of how the insurance market really works behind the scenes. We're going to guide you, give you the tools, the questions that you need to ask, the right questions that you should be asking to make sure that you can get the best deal that is out in the marketplace. And then we're going to empower you so that you can feel confident that you have the protection that is specific to your needs. So what I'd like to do first is do a quick vibe check that is right there. So if you can get your phones out, if you don't already have them out, scan this QR code. We'll see what's on everyone's mind here, because I've already mentioned insurance. There's a lot of words that come to mind, but don't overthink this. The very first word that comes to mind when we say the word insurance, write it in. While you're doing that, I'll introduce the 3 of us up here. Shawna, Rosa, I've been an employee benefits consultant for nearly 30 years. Working with employers locally all over the country, specializing in designing benefits to help strengthen recruiting and retention for employers. Also with me is Mary Campbell, who's been also an employee benefits consultant for over 20 years, working with employers of all size, of all industries, not only locally, nationally, but those that have a global presence as well. And then finally, Travis Davis here to my left, which I'm guessing many of you already know in the room. He's been in Bend for the last 20 years. He has served on EDCO board, Chamber Advocacy Council. He's had past service with BDAB, Red Cross Board, Deschutes County Search and Rescue. So he very much is in the community, works, lives, plays here. He's a licensed insurance consultant, and he does have a rare CPCU, which is Chartered Property and Casualty Underwriter designation. He can explain a little bit more about that, putting him in the top 3% of all property casualty insurance brokers around the country. So with that, so expensive is the dominant one here. That is not a surprise, necessarily. Denied, yes, we hear a lot about that, particularly I would say in the healthcare space for sure. And bummer being that there's a lot of challenges out in the insurance marketplace, whether it's the business insurance or healthcare. So a lot of what we're going to talk about today is how does Alliant show up for our clients and help address things just like this, the cost, the confusion, the challenges in the healthcare space. And when you ask our clients, they would describe us as advisors and educators and innovators, and being able to come up with creative solutions for folks like yourselves in the room is really what drives us and motivates us to do what we do every day. So what I'd like to do is turn it over to Travis so he can share the opportunity that he sees that is within reach for all buyers of the commercial insurance.
All right, thank you, Shawna. I'm going to take the next 7 minutes and really try and unpack a few key points in commercial insurance for everyone. Thank you for participating in the word cloud. I love the honesty. That's important for us to hear because we think we understand insurance. We've been doing it for a lot of years, but confusion is the first word on that word cloud that I'd like to unpack. And if we do anything, I hope we decrease confusion out there and we help you guys make better insurance decisions. The next word that jumped off the page obviously was the biggest one, expensive. So let's talk about where your premium dollar goes. That's what I have on the screen there. Between 45 and 60% of every dollar in the commercial insurance space, my space, goes toward loss expenses. These may not be your specific loss expenses, but these are the losses accrued by your peer group in the marketplace. And your peer group, if you're a tech company insured with your tech E&O through Chubb, it's all of those tech companies insured through Chubb. They need to make sure they have enough premium dollars to cover the losses. The balance of every dollar goes toward underwriting, general and administrative expenses, marketing, and carriers' hope of profit. And in case you think insurance premiums are outrageous, which they are, obviously I pay them as well, and that the profit number is way bigger than I'm representing here, I counter that it's actually the losses that are egregious rather than just the insurance premiums. In 2024, the top 4 commercial auto carriers in the country, 3 of the top 4 lost money writing auto insurance. It's their sole purpose, and they lost money. 2023, 3 out of 4 lost money. 2022, 3 out of 4 lost money. So this is not necessarily as easy or as profitable as insurance might look from the outside. So I'm going to come back to this premium dollar graphic that I have up here later. But right now, the way it's broken down, I think of 2 questions. The first is, why so much overhead? That's a lot of your premium dollar goes to overhead. And the other is, who am I sharing risk with that is having all of these losses? Because I, in my business, may not be having these losses. Those are good questions to ask, and we will get back to those questions. Next point, with how expensive insurance is, there's 3 numbers I want to go over. 4%. That's the number of Oregon workers that have filed a workers' compensation claim this year. 42%, the number of US businesses that have already suffered a cyber attack. I really appreciate US Bank hosting that previous session on fraud, and cyber is a piece of that. And then 70%, if I can get it to come up, 70% of Americans have been in at least one auto accident. I can tell you from experience, we process our clients' claims every week. Auto is our most frequent claim for our clients. So losses happen every day. That's why we have insurance. Okay, let's talk about what an insurance program looks like during the life cycle of a business. Entrepreneurs are already taking on incredible risk. So a startup, this is what their insurance program looks like. 0 insurance. Until they're forced to, they don't buy a single thing. And I fully back that. We go through a lot of consultations with startup companies, and sometimes it's 6 months before they buy their first insurance policy. Totally okay. But at some point, they sign their first contract, and maybe that requires general liability insurance, and then they hire their first employee, so they've got a couple insurance policies. They keep rolling, they keep growing. Then all of a sudden they grow and have some inventory, take out a lease space, need some property coverage. They start delivering their product, they need some auto liability coverage. And at this point, somewhere around here, a business says, gosh, Travis, I have 4 different insurance policies I'm paying for. I am covered. I think I've got everything handled. And then they find out there's a whole lot of other things they could be buying. And this list is not exhaustive, but you see here 11 different lines of coverage that businesses could be buying. I have clients buying 15 lines of coverage. There's nothing magic about this list. But it shows you that as a business matures, you have exposures that you may want to cover rather than self-insure. And some businesses follow this path, and this path leads to 11 or 15 different insurance carriers. Each one of these policies is 30 to 200 pages of legalese. I'm sure you guys all read those at night. Make sure you understand every page of those policies. And each comes with its own terms, conditions, limits, and of course, premium payments. Don't forget about premium payments. So, is there any good news, you ask? Didn't you say that I'd have an opportunity to make better business decisions? When do those come in? You just have me buying more insurance. I get it. I've just shown you a one-way ride from 0 insurance all the way to insuring everything you could possibly insure. And it's true, many businesses, many of my clients do choose this path. They fully insure everything. They don't want the balance sheet volatility, and there's nothing wrong with that approach. But there is another path that I'd like to discuss on the commercial insurance side that many mature companies choose. They may take a more direct role in their insurance with higher deductibles, self-insurance in-house, or even forming their own separate insurance captives. So these 3 questions on the screen are questions you want to ask yourself and then talk to your insurance broker about. And if the answers to these questions are, hey, I have a high risk tolerance, I have a balance sheet that's willing to accept some volatility here, how can I structure my insurance program differently? Those are fantastic questions that help us tailor an insurance program to your needs. This last question is a favorite of mine because none of us are here at Ben Venture Conference to stay stagnant or not to grow. What are my aspirational peers doing differently? Talk to your consultants, whether it be your bankers or your CPA or your insurance brokers. What are my aspirational peers doing differently? Not everybody at my level, but if I'm a 25-person tech company, what's the 100-person tech company doing that I'm not doing? If I sell to regional healthcare companies, sell my service, what do those peers who are selling to national healthcare companies doing differently? And learn from those advisors. Now let's return to the same premium dollar spend as before, but imagine this is your own money. You're still going to predict the same losses, so somewhere around half or a little more than half might be loss reserves. Notice that's not loss expenses, loss reserves. You're still going to have some overhead, some admin costs, but those are going to be about half of what a traditional insurance carrier would have. And then because you're a small sample size, and even if you join a captive with 10 or 20 other companies, you're a small sample size. So the reinsurance here is to protect your balance sheet from truly catastrophic events. You can accept maybe a $100,000 loss, maybe a $250,000 loss, but where you can't accept a $5 million loss. So the reinsurance is there for a reason. So that leaves everything on the left I mentioned as loss reserves for a very small peer group. So now you're sharing risk. Maybe it's just yourself, maybe it's a small select group, and you can realize the savings of applying risk management and risk control to your entity, to your company. If you have 0 losses, the insurance carrier no longer keeps them. You have the opportunity to keep them. Once you take part in financing your own risk in this way, you begin a virtuous cycle of risk reduction. Not only saves you money on insurance, but it also saves with a safe work culture, less downtime, lower rework costs, and that cycle continues. And just in case you all think this example is only theory, a client a few years ago moved from a $2 million fully insured auto policy to spending $2 million to self-insure, but that $2 million doesn't go to a Travelers or a Chubb or a Liberty, all wonderful companies. It goes to their own self-insured program. After their very first year as a self-insured entity with very little losses, we were able to give them over a $1 million check back. So they could do whatever they wanted to within their company with that $1 million savings. Put it back into operating capital. You can save it for a rainy day fund. In this case, they were so excited about the prospect of self-insurance that they just started building a war chest so that they could accept even more balance sheet volatility. So the takeaway from my portion here is this. Get to know your commercial insurance program. Ask yourself and your broker a lot of questions because there's one word that I think belongs on the word cloud that wasn't there, and that is opportunity. Thank you.
All right. We're going to switch gears. The other half of the insurance is protecting the health of your employees. And we're going to talk healthcare and employee benefits. And Mary, if you can get into why do employers even offer employee benefits?
Yeah.
And when should an employer consider offering an employee benefit plan?
Yeah, that's a great question because people need their medical insurance all the time. Like nobody should be without medical insurance. So if you're, you're a sole proprietor, you would want to look at the individual marketplace and maybe choose a policy that's fully insured. You just purchase it and, go on your merry way. When you start getting one more employee, so now I have two, I'm a true group plan now. So I can choose to go to the insurance carrier. I can choose to go to an association plan. The Bend Chamber of Commerce is a really good example of an association plan. Or if you're a CPA or an attorney, they have a lot of associations through those professional organizations. Some, when they're still small, they don't want to deal with employees at all. So there's professional employer organizations that actually employ your employees and then lease them back to you. Now that can be costly, you're gonna pay for that, but it's available there.
So
Yeah, please.
for those that are new to healthcare in this room, how much could an employer expect to pay to put in a healthcare program? What does that look like?
Yeah, so I took these numbers from the Bureau of Labor and Statistics. This is in June of 2025, so it is nationwide. And the Bureau of Labor and Statistics, they have the civilian, they have the government, and then they have the private industry. So what they say for all, wages, benefits, all of your benefits that you have to offer, you're going to pay $45.65 an hour per employee for all of that. Of that, you're going to have, what is medical cost? Well, medical, when you look down the line of all of the things that this includes, is actually the most expensive at $3.23. That's why we're going to focus a little bit more on cost saving on medical in this presentation, especially as you get larger. Just as an example, retirement is, a 401k is $1.14 per hour, and just Social Security and Medicare are $2.71 an hour. So just to kind of compare where medical comes up in that. So one of the things that I want to talk about a little bit are just what Travis talked about. It's the components of a health insurance premium. In health insurance, it's a little bit different than it is. We have, and I'm specifically talking about medical, but we have claims multiple times a day, not just every single day, but actually multiple times a day. So about 80% is typically anecdotally set aside to pay for your claims. But there's a lot of other parts of that. We have part of the premium that you would pay an insurance company is an incurred but not reported claim. So the claim has been, the service has happened, but it takes the hospital or the doctor a certain period of time to actually submit that claim and receive payment for that. There's the administrative fees. That's the cost of doing business, your network, paying claims, all of that. You have your stop loss premium. So even though every insurance premium within the premium has a reinsurance premium. So your stop loss premium saves you from any claims that are over a certain level. So a shock claim, a catastrophic claim. And you have taxes. I think, state taxes, federal taxes, you're taxed on your entire premium, not just the claims. So that's part of your premium as well as margin and commission. So when we break this down, like, okay, so if I'm fully insured, and say I do better, like I don't have 80% of my money that I'm paying in premium going to claims. I only have 70%. In the case of a fully insured premium, the insurance company wins. You don't have any choice in that. Now, there's a continuum of funding arrangements. So you could do a refunding arrangement. So what that is, you pay a fully insured, what looks like a fully insured premium. It's set at the beginning of the year. And then after the year is over, you go through and you do a balance. So I did 70%. So now they're going to take 50% of that 10% that what didn't go to 80% and give that back to me. So it's self-funding, but it's dipping your toes in self-funding depending on your risk tolerance. And then you have a self-funded plan. So a self-funded plan doesn't mean you have no protection at all. You still want to have stop-loss coverage in your self-insured plan. So the stop-loss, the reinsurance, that is going to be your insured part of the premium. But there's a lot of advantages beyond just, controlling your own destiny to being self-insured. And one of that is that the incurred but not reported claims, that in an insured premium is held by the insurance company. You get to hold that. So what does the insurance company do with the IBNR? They go and they invest it and they make more money on it. You can do the same thing. So it's a time value of money. Go ahead, Shawna.
I don't want to interrupt your thought process.
Sorry. The other part is taxes. So when we look at taxes, taxes are there. They're 2.5%, 3% of premium. But in an insured contract, you're paying it on the whole premium. So if you're paying $1 million in premium, you're paying 3% of that. In taxes, you're paying, if I could do math in my head, $3,000. 30, I'm sorry, yes. I knew I was going to do that. Not 100,000, $1 million. $30,000. Well, if you're just on a self-funded plan paying it on the stop-loss premium, you may only be paying $25,000 on the stop-loss premium, $10,000 to make it easier for me, so you're only paying $300. So there's a big difference in what you may pay in taxes. The other is margin. So an insurance company is going to favor on their side in the margin. They don't want to take risk because they want to make money on this. They're a money-making, some are nonprofit, but we won't get into that. So they may use 3%, they may use 5% margin. When our underwriters are looking at, what a self-insured plan should pay or budget to pay for the year, we're going to use a 1% margin. So again, say you have $800,000 in claim. That's a big difference between 3% and 1%. Commission, and this is, what we would just encourage people to do is a lot of times in an insured contract, commission is built in, and it's 3%. But that means every time I get a 20% increase, so does my broker. Well, that's not really fair, right? And so what we suggest, and just in the state of Oregon, you can only do it if you're over 100 employees, is taking a look at the commission and saying, hey, broker, let's do a fee agreement. Let's do a per employee per month type of arrangement so that you're not getting a raise every time I get an increase. And then expected claims. We talked about it. If you do better than what is expected, then you get to keep that money. That's yours. It's not the insurance company's money, so.
I'd like to take a step back to the word cloud. Expensive, loud, and in front. Biggest word up there. What are different ways or strategies, whether you're an individual trying to find healthcare, a small employer, which in healthcare is defined as under 50 employees, or a large employer over 51 employees? What are different ways or strategies that are available to be able to reduce costs?
Yeah, that's a great question. One is shopping, so looking at the market. What associations are available? Can I get a better price in the association because I have a bigger spread of risk and a larger pool to choose from? But is that the right association for me? I'm a CPA, and I don't not necessarily want to be with a bunch of truck drivers, because their health isn't as good as mine. But so it's choosing that. It's looking at the different ways. You don't have to be 100 employees to self-fund anymore. You can be lower than 100 employees. So if you have the risk tolerance, you can be 35 employees and look at self-funding. You still have protection, so it's not as risky as it sounds, but I think the old was, you can't self-insure until you're 200 employees. That's gone. There's a lot of products out there that allow you to save money, and one is even captives. So looking at a lot of smaller employers are banding together. They've been doing it in the PNC world forever, and it just hasn't hit the benefits world until now. So, if you're in that 35 to 150 or 300 life group, you can look at the captive, see what their values are, see what their products are, and see if that long run can help you save money. Because like you said, on the under 50, the only way it's all in the state of Oregon, it's all filed rates. You don't get to choose, you don't get to negotiate, you get what you get. It's based on your demographic. So the only way you can save money on a small group like that, if you're in a fully insured basis, is to fire all your old people and hire young ones. Or, encourage your older people to go on Medicare. But that's how you affect rates.
You didn't hear that here, people.
And you're not in HR.
Oh, I'm not in HR, no. And I'm not a lawyer or anything like that. I did not suggest that. That's not a good strategy. But when you get a little bit larger too, there's two types of self-funding. There's a bundled self-funding and there's an unbundled. And a bundled self-funding is with an insurance company. Super easy, you can use their solutions. When you get unbundled is where you can get a little bit more sophisticated. You can choose your different vendors that you want to use for your pharmacy benefit manager, for your network, for your point solution, for diabetes management. Any of that, you get to choose. So there's really a lot more cost savings in that. It may be a tad more work. I don't really think so, but there is a lot more cost savings in doing it that way.
Thank you.
Yeah, I hate hearing myself talk. This is really uncomfortable.
It's okay, I'll take over. Do you want to advance just to the last slide there?
Oh, yes.
I know we just have a couple minutes, and then there'll be Q&A opportunity like there was for the other meetings. But I think in close, whether it's the commercial insurance or the healthcare space, there are a lot of options out in the marketplace. There are a lot of different levers to pull. And we just want to encourage you to ask the questions, leverage the relationship you have with your broker partner, the knowledge that you've got today, received today. Expect more from your insurance because there's a lot of coverage options that are available to you. So work very closely with your broker partner, make sure you're asking the questions and that you're getting the coverage that you need and the best deal that's available out in the marketplace. And all three of us will be around the conference, the entire conference today and tomorrow. So you're welcome to reach out to us and ask any questions, and we certainly can help guide you with questions for your current broker as well.
All right.
That's it.
All right. Okay, there we are. Thank you, Shawna, Mary, and Travis. This was great. I feel like I'm like 4% smarter after listening to this. Really appreciate it. So let's hit some Q&As. If you want to ask the Alliant Insurance Services team a question, you can scan the QR code, use the series of numbers there to enter your questions. And I want to say a huge thank you to our partner CMIT Solutions for providing this tool and the Q&A support. This is such a great way to be able to do this. So how important is employee engagement and communication when it comes to future saving potentials? It's a fun question.
Yeah, that's a great question.
I like it. Okay,
yeah, no, that is.
Take it away.
Thank you, and thanks for asking that question. It's very important. If your employees aren't engaged, then they're not using their benefits correctly. They're just going to go to the emergency room instead of going and waiting a day or two and going and having an office visit. If they're not engaged, they're not going to value their benefits. They're not going to know that I have one of the better health plans. They're not going to know that I have a lifestyle account with $200 in it that I can use to buy tennis shoes or something like that. There's so much value in communication because there's soft dollars and there's hard dollars. The soft dollars are, when an employee's engaged with their benefits and overall, then they're engaged in they're going to be more productive. They're going to be more present. They're going to be there for you as an employer, but also they're going to be inquisitive and they're going to tell other employees and other people who may be looking at your company to come and work for you Hey, this is like, we have the best benefits here. These are so cool. And you hear that with certain, Shawna's also on the employee benefits side. So I don't know if you want to add anything to that.
I think you covered it beautifully. I think the other thing too is when you're an employer, there's point solution vendors that are out there that can help reduce costs in certain areas that are going to be specific to your employees. And that's where data becomes really critical if you're an employer of size, where you can get data and understand, do we have a high diabetic population? Do we have a population that's, we have a lot of MSK. So you put in those point solutions so that those employees can get access to the care that they need. But if you're not getting employees engaged, if the communications aren't happening, they don't know how to access those kind of programs, and the employees aren't engaged, you're not going to get the return as an employer on the investment that you're making for those very critical, condition management, point solution type programs. That's the only other thing I would add there.
Yeah, no, I think that's great.
Yeah, that's so important. I mean, I think it's important to recognize too, some employees are like new to getting benefits and they have no idea where to start. If my business bank accounts have been defrauded and I've lost significant funds that the bank cannot retrieve, are there solutions available for me through commercial insurance, and what are they?
Yeah, thank you for the question. So I think we have an order of operations thing here, because you're not going to buy insurance on your house while it's on fire. So if you've been defrauded, you can't go buy insurance for it. But if you had insurance in place ahead of time, could that have protected you? Great question. Two policies, one is cyber liability, one is crime coverage, offer various coverages for various types of fraud, and they have to fit in specific categories because fraud is a broad term. It could be telephone fraud, wire fraud, email hacking. It could be a host of other things. And these two policies I mentioned, cyber and crime, work together to protect a company from various bad actors. Sometimes you can actually get limits available on both policies for the same loss. But here's one public service announcement for you. If you buy $1 million cyber policy, it's never going to cover $1 million worth of social engineering or fraud loss. There's going to be a sublimit on it. So really dig into your cyber and crime policies with your broker, because most often that sublimit is $100,000, maybe $250,000. So it depends on the size of the loss. And I've had a client with a $3 million fraud loss.
Travis, this is a question for you. For a new business like mine with under 25 employees in the manufacturing space, what insurance is important for me to consider?
Well, there's the basics that anybody would say, which is your property and your work comp and those basics. But getting to the next level of coverage, I would be very clear on, do you have a product liability that is or is not covered by your general liability policy? Because you're manufacturing products, you're putting it out there into the public. There could be a loss associated with whatever product you put out there. Making sure you have product liability is first and foremost. And if you're manufacturing, if you're doing the design on your own manufacture, there's a professional liability component that I would also highly encourage you to dig into.
Great. I love this question. Do you offer more information or seminars on healthcare options for startups?
Yeah, that's a great topic. I think when we look at our seminars and what we're doing, we have a business unit that would really deal with that really small startup, and I would have to talk to them, but I'm sure that they do.
Great. Can you talk more about a PEO and what costs might look like for a startup?
That's a great question. When you look at a PEO, when we looked at that $45, right, that total cost, now the PEO is going to pay that $45. But remember that they have a larger group. So they might not be paying what you would pay as a startup for one person that you're hiring. They might pay something totally different. The benefits might be less expensive. So there's a lot of factors that go into being a small versus a larger company. But generally speaking, I've seen the PEO fees about $20 to $30, sometimes more.
So a couple things to add to that. So when you're a startup, your premium rates are going to be based on your demographics. And so the demographics are going to be the employee makeup, right? So the gender, date of birth, zip code location, and the type of plans that you're going to offer. Those plans for a startup, so essentially an employer, that 2 to 25 we were talking about, or even under 50, those rates are filed with the state. So those are released with the state, and then you've got set plans that are going to be for plan designs, and then your demographics is what's going to drive what those premium costs are going to be. If you choose to go with a PEO, they essentially lease your employees, and they operate, they lease your employees back to you. And they operate as an outsourced HR function, essentially. So sometimes it can be a benefit to you administratively to be able to be a part of a PEO, and there could be some advantages financially to look at a PEO option. I would encourage doing both, where you would look at what would it be like to be in a PEO, and then also what would it be like just to be out in the open market just ourselves, and to market those options as well. Your broker should be able to do both.
How is the impact to access to health systems affecting companies like mine in Oregon?
I probably won't, fully answer this question, so Sean, I'll let you lean in, but access is the biggest thing that I fear, and it's already happening. There's access issues. If you call your, doctor's office to get a visit, like for a routine care, my doctor's office, I know, is like 7 months out. So there's already issues. So, what do I do? How do I make sure that my employees have access? Well, there's a lot of different strategies being used. One is direct primary care clinics that maybe a group of employers in a certain area, especially an area that has limited access, looks at it starting a direct primary care clinic. But it's also, the reason that the companies can't come to an agreement is because usually the provider wants more than the insurance company, and the insurance company doesn't want to pay as much. I mean, costs are increasing so much, and health systems are either making money or losing money, and it's all kind of a cyclical thing on which carrier. But we're seeing more and more of it, and we're seeing more and more of not acquiescing to each other. I mean, the big thing is Salem Health is, still not taking Regents members in Salem and actively denying them. So it can get really, it can be part of the community and a bigger part of, affecting your employees.
I will say access to healthcare has continued to be a challenge, and it is not just in Oregon, but all over the country. Yeah. So provider shortage is a very big problem. And you've all seen too the contract negotiations that are happening because they're putting it out in the news. Contract negotiations between hospital systems and the insurance companies have been happening for as long as I can remember, for years. But what they haven't historically done is actually put it out in the news. And so that's why now you're seeing in the news where the Salem Health of the world, right, or different hospital systems, St. Charles, exactly, that we're negotiating our contract with Aetna or Cigna or Regents Blue Cross Blue Shield or whoever it may be, and there's that push and pull, right? And so the provider system wants more money, and they have a shortage of providers. The insurance company saying, well, we want to keep costs as low as we can so we can keep premiums low. And that's going to be reflected in the premiums you pay. So it's absolutely influencing, whether you're an individual, small employer, or large employer, the costs of healthcare. And in terms of access, the telehealth and virtual care is something we've seen a lot of employers implementing and really leaning in on to be able to get better access for their employees. And that includes behavioral health too. That's something that we've seen grown a lot, is virtual care for behavioral health.
Thank you so much. This has been so informative. Shawna, Travis, Mary, we appreciate you so much. Thank you, Alliant Insurance, for making this happen. How about a round of applause for our panel?